What is a buydown? A buydown is a mortgage financing technique with which the buyer attempts to obtain a lower interest rate for at least the first few years of the mortgage or possibly its entire life. Buydowns are easy to understand if you think of them as a mortgage subsidy offered by the seller on behalf of the home buyer. Typically, the seller contributes funds to an escrow account that subsidizes the loan during the first years, resulting in a lower monthly payment on the mortgage. This lower payment allows the home buyer to qualify more easily for the mortgage. Builders or sellers may offer a buy down option to help increase the chances of selling the property by making it more affordable. The builder or seller of the property usually provides payments to the mortgage lending institution, which in turn lowers the buyer's monthly interest rate and therefore monthly payment. The home seller, however, usually will increase the purchase price of the home to compensate for the cost of the buy down agreement. Buy down terms can be structured in various ways for mortgage loans. Most buy downs last for a few years. Then the mortgage payments increase to a standard rate once the buy down expires. A 3-2-1 and a 2-1 mortgage buy down are two common structures lenders can use. In a 3-2-1 buy down, the buyer pays lower payments on the loan for the first 3 years. For each of the first 3 years of the mortgage, the buyer's interest rate would increase incrementally by 1% annually. The full interest rate would apply beginning with the fourth year of the mortgage. While the buyer received savings from the lower interest rate in the first 3 years, the difference in the payments would have been made by the seller to the lender as a subsidy. A 2-1 buydown is structured the same as a 3-2-1 buydown. However, its discount is only available for the first 2 years. So you would have a 2% interest rate reduction for the first year of the mortgage, then a 1% rate discount for the second year of the mortgage. Your interest rate and your monthly payments would increase over time until your loan reaches its actual percentage rate. This happens in year 3 of the loan. At this point, your monthly mortgage payment would reflect the true loan rate. You would pay upfront for the 2-1 buydown at closing, and theoretically, the money that you save over the first 2 years would cancel out that payment. Pros and cons. Whether it makes sense to use a buydown to purchase a home can depend on several things, including the amount of the mortgage, your initial interest rate, the amount you could save in interest over the initial loan term, and your estimated future income. How long you plan to stay in the home also can come into play for determining your break even point. Pros. A buydown temporarily reduces your interest rate, saving you money and lowering your monthly payment during the initial loan term. Choosing a buydown may allow you to pay less for the home than the seller's listing price. It could make sense for homebuyers whose income will increase in the years to come. Cons. Once the buydowns or the buydown rate ends, your monthly payment could be higher than expected. A buydown may not be an option for certain property types or loan types. If your income doesn't increase, then you could struggle with making monthly mortgage payments. Here are a few examples of how a buy down mortgage can work. Say you're borrowing 250,000 with a 30-year fixed rate loan at a 6.75% interest. You can choose between a 2-1 buy down or a 3-2-1 buy down. In a 2-1 buy down, your first year you'll pay $1,304 at 4.75%. Year two, 1459 at 5.75, and year three, 1622, $1,622 at the full 6.75% interest. On a 3-2-1 buy down, on your first year, you'll pay $1,158 at 3.75%. Year two, 1304 at 4.75%. Year three, 1459 at 5.75% interest. And in year four, $1,622 at the full 6.75% interest rate. So, when considering a buy down, it is important to look beyond the initial low payment period to determine whether the costs involved in the near term are worth any interest savings you might realize. A buy down could make sense for buyers if it allows them to get a mortgage without significantly increasing the purchase price of the home or draining their cash reserves. Buy downs also may be more appropriate for people who have stable income set to grow over the life of the loan, making it easier to keep up with the payment increases once the initial rate period ends. But again, timing matters. If you don't plan to stay in the home for at least 5 years, then you might not see any real savings at all from a buy down.